Very good morning to all of you. Please let me know if you can hear me and see me. Great. Thank you very much. So, welcome back to the tax course. I'm excited because for the first time in a long time, I'm teaching the tax course outside of our traditional classrooms. I did it last time in last year around this time, and I'm doing it again. Um, as I mentioned before, we will have some initial teething issues in terms of how to approach tax law, especially for students and practitioners who aren't used to either the law or tax. And I can assure you that if you work hard, that won't be an issue later on in the course. You will have to work a bit harder in the first few weeks of the course, only because we are teaching the basics and it's important that we all are on the same page. But once you carry on through that, you will realize that tax law is one of the most fascinating subjects in the area of law. It has tremendous amount of significance in almost all our commercial transactions, and it has an ability to go really deep into some very fascinating, interesting, productive statutory enactments and case law. Now, when we started last time, we had just discussed the basics of taxation, and we had discussed what makes up an income tax. We had kind of talked about the design of the tax system, the basic principles that underlie the elements of a tax system. At this point of time, those are elements and principles and features that will be probably merely words and phrases for most of you. And they'll come alive only after we have gone through several sessions of tax law. Today, we are continuing in that vein, in the sense that we are going to start talking about some features of tax law that everyone ought to understand. And these are the features that sometimes people who are not used to tax law find it puzzling. Right? And finding something puzzling is always good because then that means there's some pedagogical challenge there. We can sit together and try to learn what's puzzling about a certain area or domain of law and then get through it. So that's what we'll do today. We'll be talking about some really interesting building blocks of income tax law, and then after that we'll proceed with things about what is income and how is income treated in the Income Tax Act and so many of those other things. All right, so let's start. I'm just going to share my screen and we'll begin. Right. So we are in the concept and nature of Indian Income Tax Act today. And what we're doing there is we are discussing some cases that are of particular importance in this area and which we think are vital in our understanding of income tax law. Now, if any of you have actually picked up an income tax textbook, you will realize that many of these cases that we are doing today may not even be dealt with there. And the reason for that is that many people who discuss the Income Tax Act start with the application of some section or the other of the Income Tax Act. That is not the approach here. I want to first understand and make you understand what might be certain underlying principles in the Income Tax Act without reference to any particular section number for the time being. Of course, we'll get there. Whenever we talk about the Income Tax Act, we're going to get to some statutory provision or the other, but that's not our point of analysis right now. We're going to start with something more basic. Yeah, just give me a second, please. Yeah. Yeah. So what are we doing today? We are talking about three very interesting cases. One English and the other two are Indian. Cases we are talking about are Sharkey versus Warner, which is an
Didi,
English case. And then we are going to be talking about Kikabai Premchand, which is a US Indian Supreme Court case. And we are going to talk about CIT versus Shirin Bai Kuka, which was a Bombay High Court decision that then finally went to the Supreme Court, but we'll be focusing on the Bombay High Court decision. These are old cases, but really important cases in trying to understand what are the principles underlying not just Income Tax Act, but the idea of the imposition of income tax on our income. Just a minute, please. Just give me a minute. So let's start with that. Let's start with the idea of realization of income, right? And sorry, before that, before we go to the realization of income, what are we trying to see in this session, in today's session? We are going to be talking about what we mean by realization of income, what is the issue with separate legal personality, and what are the issues with self-dealing. Again, these are just words and phrases for the time being.
Didi,
We are yet to understand these in any great detail.
Didi.
But we'll come to the detail in a minute. Can I request everyone to mute their microphones, please, except for mine? Realization of income is the first thing that we should talk about. Friends, here, what's important, and I think this is sometimes lost in the discussion of tax, is that income tax is a tax when income is earned. So this is a pretty critical concept, and I want you to understand this carefully. Income tax is a tax when some person earns income, right? And another way of putting that same concept is to say that income tax is a tax on the realization of income, right? And why are we so concerned with that? We are concerned with that because we are all sitting here today thinking about income tax. And what we are really thinking about is not so much about what to do when we earn some income, or what do we do when our economic situation improves, but what are the conditions in which, when our economic situation improves, we are taxed for some reason or the other. In other words, we are not just concerned with income as a static concept, we are concerned with income as a concept where income tax is imposed only when we earn or realize some income. Right? That's the basic idea of the Indian Income Tax Act. We went through some provisions in the last week's session, where we said, Section 4 says that when there's a certain tax on income, but underlying that idea in Section 4, which taxes income, is that income can only be taxed when it is earned or realized, right? And it is in that space where people are debating about whether something's realized or not that many debates about income tax take place. I'm going to actually start or discuss with you a case that's not an Indian case, it's an American case. It's a case that actually is quite well known as tax cases go. And this case was in the news a few years ago. It's called Moore versus United States. It's a US Supreme Court case. And I wanted to give you this case to um, underline this point about realization of income, right? So in Moore versus United States, this is a company which is an Indian company with American shareholders. And when I say Indian company, I mean a company that's incorporated in India. It's registered in India, and the issue was uh, American shareholders, will they be taxed as the Indian company makes money? Remember that the Indian company may be making some money. I think this was an agricultural machinery company. It may be making money in India, earning money because it's buying and selling things. It has some shareholders in America. And the question in this case was that when there is um, income um, and the underlying Indian company, how will it be taxed when the Indian company earns money? The reason why this case, the U.S. case, of course, had U.S. tax issues in it, and there was some discussion about the differences between direct tax and indirect tax in that U.S. Supreme Court case, not relevant to our discussion. But what's relevant to our discussion was that they looked into this question about unrealized gains being taxed in income, and they were making the point that any gain or income has to be realized in order to be taxed, right? And the idea there was that realization, if you have an Indian company that's earning money in India, but it's not sending any dividends back to its American shareholders, it's not sending money back to its American shareholders, then you can't say that the American shareholders have realized any gain or any income for purposes of taxation. So that case was a case where if you try to impute income to the American shareholders by saying as and when the Indian company earns income in India, the American shareholders will be taxed. That is not possible because the very concept of income is income tax has to be realized. The shareholders have to get something in their hands or have control or access over money in order for them to be taxed. So this idea of realization of income is very important, and that was the underlying idea in Section 4 of the Indian Income Tax Act, which we discussed last time. And in that, we had discussed this idea that income ought to be realized. And of course, what we mean by realization of income has to be earned, and what we mean by earning or realization are things that are brought out later on in the scheduler system, where each of these incomes are calculated under various heads like salaries, income from house property, capital gains, income from other sources, income from business, etc. So keep that realization of income idea in your head, and we'll talk about that in a bit in more detail. There are several sources of now. If you go to the right hand side of the slide, you will notice that under Section 5, residents are taxed on their global income earned both in and out of the country, and non-residents are taxed only on income that is earned or deemed to be earned within the country. Of course, we need to find out what that means. How is something earned within the country or outside the country? But keep Section 5 in mind as well. And then Section 6 talks about test of residency. For individuals, roughly the test is that if an individual is in India half the year, 180 days, he or she is resident in India. And if a company is incorporated in India, then it is an Indian resident for Indian tax purposes. If it's incorporated abroad, it's a non-resident for Indian tax purposes. Um, Why am I mentioning all of these things? Because these are the basic building blocks of tax. Let me review that for you again once more before I go to the cases. Um, the Indian Income Tax Act is designed in such a way that it first talks about income. It says that income will be taxed under the Income Tax Act. Then it says that income that's earned by a resident is taxed wherever it arises. So residents are taxed on their global income. Then it says income that's earned by non-residents are taxed only if it is earned or sourced in India, so only on the Indian source income. That's mentioned in Section 5 as well. And then who is a resident or what is a resident is decided in Section 6. And for the time being, I've just given you a kind of a rough idea of what Section 6 is for individuals. An individual is resident when they are in India. They reside in India half the year, 180 days. And for companies, they are resident if they are incorporated in India, right? And this is just kind of the basic features of the income tax design of India that I'm talking about right now before I move on to some case law that talks about the basics of income tax. At this stage, can I just stop and ask if anybody has any questions, comments, anything that they want to talk about in more detail? Um, Please do let me know. Um, I'll just see where we are. Just give me a second, please. Yes. So could you let me know if there's anything that you, at this point of time, that you wanted to talk to me about? You could either raise your hand or you can say something in the chat box. Otherwise, I'll just move on to the next part of the slide. Okay. All right. Yeah, I think Henry has raised his hand. Yes, please, Henry, go
Yes,
ahead.
sir. Sir, I just need little more detail on the non-residents under Section 5.
Yeah. So, sure. So, what's interesting about the Indian system of taxation is that there are several questions that arise at the foundational level. First question is whether somebody, whether if somebody's economic situation is improved because of some reason or the other, is that income for income tax purposes? And that question is sometimes phrased as whether that person has realized any income or not. So the idea of realization of income is built into the idea of income, right? So, for example, we were talking about last time of somebody hitting a cricket ball in a stadium, it lands in your hands. And of course, your economic situation has improved, I suppose, because it's a valuable cricket ball, not just the value of the ball, but also the kind of nostalgic value attached to the ball might have some monetary consequences. But whether that, as a result of your economic situation being improved, whether there is an income realization is an entirely different question altogether. It's a question that can only be answered from within the Income Tax Act and some basic income tax principles. And one might say that, look, just something landing in your lap is not doesn't bring it within any of the schedules in the Income Tax Act. It's not a salary, it's not business income, it's not even income from other sources, and therefore there's no you can't have an income tax. You may have had an economic benefit, but it doesn't amount to income tax under the Act. Separate from that question, although linked to it, is the question of jurisdiction, right? It's not only a question of realization, but it's also a question of jurisdiction. And by jurisdiction, I mean that even if something is income for income tax purposes, even if there has been a realization event, even if the income has been realized, countries can't tax that income unless the country can assert jurisdiction over it. And that jurisdictional question, which is separate from the question on realization is a question that comes to the fore in when it comes to residents and non-residents. When it comes to Indian residents, people who reside in India, it doesn't matter where the income arises. The income can arise in India, the income can arise outside India, they'll be taxed. Nevertheless, as long as what has happened to them is they've realized some income. Whereas for non residents, that is people who can be considered as not those who reside in India, people other than those residing in India, their income can only be taxed if they have an Indian source income. That income has arisen in India in some ways, right? And non-residents are defined different defining rules for individuals and for corporations. We've gone through that, and I think you might be asking, well, that's fine, but what is the when you say it's earned in India or has an Indian source income? What does that mean? And that's something we'll do in the rest of the course when we come to section 9 and the source of income and what might be considered as an Indian source income and what might be considered as a non-Indian source income. So, for example, if I own a building in India, it's very clear, and I sell the building, it's an Indian source capital gains. But it is less clear if I own a share in an Indian company, which is an intangible property. It's not tangible property. I mean, I can't, it's not kind of a share is the only thing you can think about a share of a company is it's a share. It's some kind of a part ownership of a company, but it doesn't have a kind of tangible property that other properties have. And then the question would be, how do we know whether when I sell the shares of an Indian, assume I'm a non-resident, I'm outside India. How do you know? How does anybody know that when I sell the shares of an Indian company, that I am
Hello.
earning Indian source income?
Hello.
So
Hello.
that's the question that arises here. Sorry, is there someone who wants to ask a question? I'm hearing some voices.
Hello. Join करो.
Uh, Otherwise, you'll have to mute yourself,
Okay.
please.
Bye.
Yeah.
Excuse me, sir.
So yes, yes,
So,
Rohil had raised his hand. Yes, yeah.
yes, sir. Sir, the
Hmm.
same US versus Moore case,
Hmm.
uh, while the debate is on the fact that whether it's a realized income or not,
Hmm.
over here, these are two non-residents who are generating income from India.
Hmm.
So, in this case, will they be doubly
Manisha.
taxed from India and USA, or how does that double taxation work?
Sorry, are you talking about the US's more case, the specifics of the case? Because
Uh,
we don't have to worry about the specifics there. Those
Not the
the,
specifics, sir.
hmm.
Just an example.
Yeah, I'm
Uh,
just sorry, just to interrupt you. I'm sorry to interrupt. What I meant was when I went by specifics is that the issue there arose because of some distinctions between direct and indirect taxation, which only have a US analog. They really don't have a Indian. There's no Indian comparative framework that we have here. But if I'll just say what I think you want to say, and correct me if I'm wrong. And then we can go forward. I think what
yes, sir.
you're talking about is a situation where a non-resident are earning money from an Indian source in some manner or the other. It could be that they have a building in India or they're selling some Indian property that's somehow related to India, in which case India is able to tax that income. Take a simplest case: an American owns an Indian building, Indian hotel property, and that American sells the hotel property. Because the hotel is situated in India, it's clear that it has an Indian source income, and therefore India can assert its tax jurisdiction over that property, and India can tax it. However, because that person is a US resident, it might well be the case, and in fact, it is actually the case, that America would also be able to assert its ability to tax that American because that American is a resident in America and is taxed on their global income. And therefore, this might lead to a double tax situation. Rohil, is this what you were referring to, or are you referring to something else?
Yes, sir. So just this, and what if the opposite also happens, where an Indian resident earns outside India and he's taxed there? Will he also be taxed here?
That's right. So, and the opposite can well happen. It happens quite frequently, where an Indian resident earns income in some other country and is taxed in India, of course, because of Section 5. Global income is taxed of an Indian. And because of the tax rules in other countries, he or she or they may be taxed on the income that they've earned outside India and they may be taxed by some other country. So these are frequent double taxation issues that arise in the world, and India and other countries have entered into several double tax treaties to solve this problem of double taxation, which is that the same item of income is being taxed by two countries because they're both legitimately asserting their jurisdiction. And so we have a session entirely devoted to this, which is that when there is double taxation, how do we mitigate the hardship on the taxpayers? This is a very important and frequently occurring topic, and we'll be referring to it.
Got it, sir. Thank you.
Great. Okay, so let's get back to our case, and we'll see where we are on that. All right. Yeah. So we are on the next page, which is now on questions of self-dealing, etc. Let's look at question 2 of note 2 again. So I refer you back to my materials that I've submitted to you, and please go there and go to note 2, please, all of you. And you must, when you are in my class, you must have the cases and materials that I've given you with you, my course materials, because I'll frequently refer to that as and when I'm teaching you. This is the problem question on page 3, where I have stated in the second paragraph. We already did the first paragraph in the first class, and now I'm in the second paragraph. And the second paragraph, I'll just read it out for you, just one part of it, which is that A has a family that consists of his wife and his only child B. A is a seller of furniture and fittings meant for residences. In order to help B, A decides to withdraw some of the furniture from the business and give it to B for no consideration. Just this, right? So now we have a situation where there is some self dealing going on, in the sense A is taking out something, A is transferring furniture to his child, and would it be chargeable under the Income Tax Act? Is the question, right? Now, you know what I'll do right now is let me just give you 5 minutes. Don't look at the facts of the case or anything right now, right? Just think about how you'll deal with this situation without referring to anything. Don't look at Google, don't look at the cases I've given you, don't look at the course materials. When I come back in 5 minutes, in exactly 5 minutes, I want you to tell me, if you didn't know anything about tax law, how would you decide this case, right? So there's only this. A has a family, consists of his wife and only child. He's the seller of furniture. He takes out some of the furniture and gives it to his child B. Yeah, 5 minutes, I'll be back. Yes, friends, who's going to talk me through this? Either in the chat box or by raising your hands, please. Yes, please, Henry.
So according to me, there is no realization of income. See, this is just a transfer between A to his child.
Hmm. And so, what is your idea of realization of income here? That's a good point. What's your idea of realization of
Yes, sir.
income?
So to make it even more clear, so if it was a separate legal entity like a company, if the
Hmm.
assets have been transferring in their balance sheet or the P&L wherever it is, so they would have realized it as an asset and furniture. So that would have been a value for it. So here, since it's been transferred to his child,
Hmm.
so I don't think it has been realized or recognized as an income, so it's not taxable, according to me. So correct me
Yeah.
if I'm wrong.
No, no, no. It's a very good response, and in fact, there are two. So I'm going to Tanmay in a second, but before I go to Tanmay, so that every one of us is on the same page here, let's just understand what's going on. I'm a trader. Buy and sell furniture. I might even manufacture and sell furniture, and I use the furniture not to sell it to a third party, but for my own benefit. I've given it to my child, but I'm really using it for my own benefit. My child needs it, I take it out and give it to my child. And the question then is whether there's income for income tax purposes. And one way of looking at it, as Henry did, is to say that there is no realization. There's something that has occurred, some kind of trade, I suppose, but there's no realization of income because I'm just using it for my own benefit. But I, ha- I want to see if I can get to the bottom of this in some other way. Why do we say there's no realization? We intuitively think there's no realization, but why is that? Why do we think there's no realization? And let's see, let's talk. So Tanmay first and then Rohil after that. Yes, Tanmay.
Sir, I think it will not be treated as income for the reason that first of all, it is being used for personal consumption in the family itself, as the example is not telling it that it is being used for the company. It is used plus there is no consideration. So, as per my understanding, it would not be income because there is no profit making in the hands of A, and plus, according to me, it will not be covered under either of the heads of income.
Yeah, but good. Now, my one follow-up question for you, Tanmay, which is when you say that. Let me ask you this question in a slightly different way, and let's see if I can make you think in some other way. Which is, if I were to ask you, not whether A has earned any income, because that's almost begging the question in some ways. If I were to ask you instead of that question, some other kind of question, which is the following: can you tell me if, in your opinion, A has benefited from this transaction?
Sir, no, sir.
If I were to tell you in response to what you just told me, that ordinarily, let's say that B is a very demanding child. B wants furniture.
Okay.
Ordinarily, A would have to go out into the market, buy furniture, and give it to B. And so he has to spend some money. He doesn't have to do that, fortunately, because he is the owner of a furniture shop. So he can take out the furniture and give it to B. Now, would you like to tell me if you think A has benefited from this transaction?
Sir, A has benefited in the sense that if it would have been a purchase from the market, then he would have spent the cost of the product plus the profit margin of the seller who is selling. But here, what he has only benefited is the profit margin, which he has foregone
That's
for the reason that it was is a family transaction.
that's right. So that profit margin at least is a benefit for him, for A.
Sir,
Would you
yes,
agree?
sir.
Then would you say that
Yes, sir.
shouldn't that be taxed? He has benefited economically.
Sir, economically he has benefited, but according to my understanding, it would still not be treated as income in his hand, because it is not something which he has earned, but which is something which he has would have to spend, but on a different footing, if you can say. He has not earned, he has benefited indirectly, but in a sense, I think it is not being earned.
It's true. So then your answer is slightly different from the one you gave before, and it's actually an answer that we should all think about very carefully, which is that this could be a situation in which A has profited in some manner. We notice he
Yes,
has profited because he doesn't have to worry about the profit margin that other people earn by selling him furniture. But even though there's some profit to A in this transaction, it is also true that it is not a transaction in which he can say he has earned this profit by way of trade. Because it's not by way of trade. He hasn't sold it
yes,
to
sir.
anybody. He has just taken it out. So then we might have a slightly different answer from the one you gave before, which is that this is a question not so much about whether A has economically profited, but whether A has any income under any of the schedules of the Act, in particular, whether A has income under the business schedule, which is a trading
Yes, sir.
schedule. Right.
Yes,
Okay.
sir.
And we'll get back to you on that in a second. I think there are other people who raised their hands. Was it Rohil? I'm seeing
Yes,
Rohil's
sir.
hand still raised. Yes. And
Yes, sir.
who else has raised their hands? I only noticed Rohil is somebody and Dheeraj. Yes, Rohil. Go ahead and then Dheeraj after that. Yeah. Yes, please.
So just to counter the question you asked, Tanmay, so
Hmm.
in this case, whether A purchases this from a retail showroom or purchases this from a wholesale showroom, he still has paid some amount to get the furniture.
Yes.
So, sir, the question of there being an opportunity income being denied over here, or that profit margin being ignored over here, should not come into consideration because he still purchased it from some amount and he's not gotten the furniture for free.
That's correct. He didn't get the furniture for free, but he's able to satisfy his child's demands without going to the market and paying anything more. He's
Correct.
just paid whatever he paid for his furniture. Yeah. Whatever is lost is just the cost of the furniture.
Correct. And so just
Which
to answer
let's
the
let's let, let's say
question,
that let's say he had to spend more for his furniture if he had to go into the market. Instead of 50 rupees, he had to spend 100 rupees. So that 50 rupees difference is still something he's benefited economically.
yeah, so that's because he's a smart buyer. And the fact that he's a smart buyer, he cannot be taxed on the same thing. Let's say showroom A and
No, no,
showroom
no, no,
B.
no, 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 no. I'm not on that yet. I'm not on whether what are the knockdown consequences of what he did. I'm just
Okay.
asking a much more simpler question.
Mhm.
Have he, whether because he's smart or because um, he's an exploiter of good fortune, whichever might be the reasons or causal reasons for him getting this benefit. The fact is, he's got
Mhm.
some benefit, some economic benefit. That's all I'm at right now. And
Okay.
then the question is whether Income Tax Act is the kind of legislation, the kind of framework that can capture that economic benefit for tax purposes. Yeah, that's where we are.
Got it.
Yeah. Now, the Dheeraj, and then after Dheeraj, I'm just going to go back to the
Also,
case and go tell you what it is. Sorry,
also
Rohil, you
wanted
had
to
something
answer
else to
the
say. Oh,
question.
sorry, Rohil. Yes, go ahead. Sorry. Yeah.
Yes, sir. So in this case, since the furniture is being withdrawn from the business, it comes under drawings. And if he is paying consideration to the
Yes.
business, if A is paying consideration to the business, then it would be directly a cash. It would come under a cash sale without profit. Since there's no profit in this case, there won't be any application of income tax. Maybe GST, but not income tax in this case.
Yeah, we're not talking about GST at all. In fact, GST captures this. But let's not. worry about GST for the time being. But even income tax. So you're saying there's no income tax. There's no tax to be paid.
There's no income, so no tax.
Got it. Got it. Oh, well, that's interesting. There's no income, therefore there's no tax. I was going to tell you that. Oh, hold on. Again, just so that people are not confused here. Are you saying that there is no realization of income and therefore there is no tax? Because
Yes, sir. There's no realization.
by that I mean when I say realization of income, I mean it's captured in some schedule of the act, profits, a
Yes.
business or
There's no
salary or.
realization because his capital account is getting reduced in this
Okay,
case.
got it, got it. Okay, Dheeraj, for the last word before I go back to my slides. Yeah.
Yes, sir. So I was looking at the point where this purchase, whether it was a trade or a manufacture activity, there were certain number of purchases that were made in respect of bringing out this end product of chair, the furniture. So when such purchases are already accounted in the AS books, wherein he'll be getting the benefit of overall income reduction. So simply writing off the taking outside of it, not calling it a sale. Uh, a chair was manufactured or bought for which there was some purchase value, which was accounted in his books on the expenditure side. And now that chair is taken out of his books, whether it was for I mean, for his personal consumption, for his son, for his related party, or maybe giving out as a gift, donation, whatever. Unless there is a specific clause in the law which we are referring to, income tax legislation, which says that in certain cases, such taking outs from your inventory will not be considered as towards consideration, and still the purchases can be accounted. Unless there is a specific legislation like that within the law, I think this is not consistent with how business works. Like it is given out, yes, maybe one of our friends Rohil was telling, it is withdrawn from the business, so there should be some kind of notional value at least that should be accorded to it. Just to add on another point, things like corporate social responsibility, donation, gifting, whatever we do, we cannot apportion a value for the move outside, like going outside of those goods. But if we just take it on face value, stating that there is no income or there is no consideration in cash, and that's the reason it should not be even considered under the ambit of the income tax provision, I feel that's an inconsistent take. I don't know exactly about the provisions of the income tax law which govern these kinds of transactions, but I so
But
much feel definitely
so can I? So is your conclusion that there should be a tax on it?
there should be a tax. It's only about the
Because
valuation.
because I might just to finish your argument, I might say just tell me if you agree with this kind of. I'm going to restate what you're saying in a little bit. You're saying that whether it is a when property leaves the business,
Right.
whether it's apples, oranges, furniture, when property leaves the business, whether it is in the context of a market transaction or otherwise, there should be some tax imposed on it. Is that the way you're going?
Yes, sir. Unless there is a specific provision within the legislation that certain
Yes,
transactions should not be taxed, it
that's
should
right.
be taxed.
That's right. That's right. I got it. I got it. And I think I'm trying to interrogate the instincts on the basis of which you're saying it. I'm trying to see why you're saying it, and where you might be coming from is that you
Yeah.
might be saying that whenever somebody is in business and they've expended some amount of money on the purchases, if that property that you use the word inventory, but inventory is a technical word. I'll just stick to colloquial words. Whenever property is leaves the business, whether it leaves the business because of a market transaction or otherwise, it should be accounted for. Otherwise, there'll be some inconsistency between that and your usual market sales. And in order to maintain consistency, you must account for it as a notional sale, as something that is not an actual sale, but is equivalent to a sale. Is that is that a is that an
Yes,
appropriate way of putting it? Dheeraj?
Yes, sir, exactly.
Okay, all right, got it. Okay, so these are the two way. Already we can see that there are two viewpoints on this, right? And these viewpoints actually depend on how we understand income tax. One viewpoint is that there could be profits, or somebody could have profited from a transaction, but every profitable transaction doesn't result in realization of income. Whereas the other viewpoint is no, all profitable transactions, all transactions that are indulged by in a business must result in some realization of income for tax purposes. We are not sure which of these two positions to take, and what is the and which position is stronger. We'll come to that in a second. But let's just understand that. In fact, I was going to go ahead because we are losing some time, but I'm actually quite happy that people are jumping in and participating. So I'll make an exception to my usual rule, and I'll ask. I think Atul, somebody called Atul had raised a hand. I think with that, we'll go for. Isn't that somebody called Atul had raised a hand? I thought.
Yes, sir. Yes, sir.
Yes, Atul. Yes.
Sir, in my opinion, the entity having done the transaction. So while any transaction, the books has to be recorded the value of the every item, whether it will be given to their relative or their it directly sales to these things. If any value has been added from their buying, it should be taxed. Otherwise, is that further the transaction has been sold to their related party transaction, it will be uh, part to whatever tax has been applicable or not. But realization is realization added to the value. It should be taxed in
Yeah, I
books
think
if it's
that's yeah. I think it's a point akin to or similar to what Dheeraj was making, which is that if you have a valuable product, and the product is valuable because of something that's processed at your end, that value has to be captured as it goes out or leaves the business for tax purposes. Great. All right. So now and I'm sorry if I've not been able to call on everybody here. Just in the interest of time, let me just go back to my presentation, and I'll tell you what happened with cases like this. Yeah, so in this case, the way this case has developed, there are divergent approaches to this case in English law and Indian law. The English law on this point is captured in an old case called Sharkey versus Werner. This is in the early part of the 20th century. And in this case, the facts were that there was somebody called Lady Zia, who was a racehorse owner and breeder. She owned a stud farm and was engaged in horse racing, which is a non-taxable hobby. Occasionally, horses were transferred from a stud farm to her racing activities. And the stud farm was a profitable trading business. As in, a stud farm basically is a farm where you acquire horses from various places and then you sell it, right? And you sell those horses. So, I mean, in some ways, it's no different from buying and selling anything else, furniture, or oranges, apples, etc. The question arose as to how these transfers should be treated for tax purposes. And the issue, therefore, in the case was whether assets transferred by a person from her unincorporated business to herself should be treated as resulting in taxable income. And this went all the way to the highest court of the land in the UK, which was at that point of time the House of Lords, as many of you might already know. House of Lords in the UK now is called the UK Supreme Court, so much like the Indian Supreme Court or the American Supreme Court. And their reasoning was that even though no actual sale had occurred, horses had just been transferred to herself, there was a notional sale, as some of you have pointed out, when the horses were transferred by the taxpayer to herself. And the market value of the horses at the time of transfer was deemed as income for tax purposes. And so the principle that we are talking about here is that when assets are transferred from a taxable part of a business to a non-taxable part, the transfer should be treated as if the assets had been sold at market value. Now, so in this case, it's very interesting. You can already see a divergence. You can already see that uh, there's been a certain position taken which may be quite different from what you might be thinking of, which is that in this case, um, there is tax as if a sale had occurred, even though no sale had actually occurred, right? And that's because, as the court is trying to say, you are in business, you're doing some business, you already added value to whatever has come into your business, you processed it, you made something. And then if you're going and transferring it outside of your business, that ought to be captured under income tax law, even if you've not received any um, monetary benefit uh, in return for it. Right? And this is the stand taken by the UK court in this case. Interestingly, Indian cases have deviated from this principle, as we will discuss in the case of Kikabai Premchand and Shirinbai Kuka, but we will do that after a short break when we come back. So we will come back in 10 minutes time, and I'll take you through those two cases and try to figure out what kind of principles we can draw from these cases, and if we can reconcile the Indian case law and the and UK case law at this point. So we will be back in 10 minutes. Okay, thank you. All right. Welcome back. We said that um, income needs to be realized, and that question of income being realized is actually quite an interesting question, because normally that may not be a big issue when you earn a salary or you're selling something, but it becomes a complicated issue in some circumstances. And in those issues, we bring out then the kind of the features of income tax law by looking at those kind of complex um, uh, circumstances that usually don't arise to mind. And your Sharkey versus Werner, your furniture case is one of those kind of things. And today, and now what we'll do for the rest of the session is to look at Indian cases. And interestingly, Indian cases have diverged from what's happening here. So before that, Yash had raised the hand. Yes, Yash, did you have something to say?
Hello.
Hi. Yes.
Yeah. So as we saw that case of A has a family consist of wife and only children B. That A has sell the furniture, not sell, he has given to B, right? So
Right.
as per my knowledge, in indirect taxation also we have a concept of like kind concepts. Even if we are giving to any person, we have to charge a basic nominal fee according to market conditions. So it can be a tax, right?
Yes. That. Yes. I mean, that's exactly what Shaki was the one who said, that when you whether when you're in business, in her case it's a stud farm. In our case, it could be, you know, selling vegetables. When you're in business and you're transferring something out of your business, something has to be captured, and that what is captured is a value equivalent to market value when you transfer something. So I understand where you're coming from, Yash. My only point is, on what basis are we saying it? What is the conceptual foundation of that? And if any of you are wondering why are we discussing this, because some of you might be wondering, well, okay, this is an extraordinary case. People are, usually it's not the usual case. People buy and sell stuff in the market all the time. Why are we focusing on something that's happening outside of the market? There are two reasons why we are doing it. One is that we believe that only in understanding, only by figuring out the cases at the margins, will we be able to figure out what are the basis for the cases in the middle, right? So we understand and sharpen our principles better when we look at cases on the margins. That's the first thing. Second thing, which is even more interesting in my opinion, is that these cases that I'm talking about are no longer on the margins. That, as you will see, the long shadows of Sharkey versus Werner will actually affect many international transactions today as well, right? And so but of course I'm saying something enigmatic. I'm not saying something which might be clear to you right now, but it's something that we'll come back to in a second, and I'll explain that further. Right. Okay. So now let me now go back to my slides, and I'll tell you the Indian cases that we are talking about and why they diverge from the cases that we have been talking about so far. So, Indian cases, if you see Kikabai Premchand versus Commission Income Tax, which is actually similar, very similar to the facts that I've just given you. The facts of the Kikabai Premchand case is that Kikabai Premchand used to withdraw silver bars and shares from his business stock and transfer them to his personal investment account. Now, these transactions, and of course, what he did I mean, we have simplified the facts here. What he used to do is he used to take them out and put them in a trust, of which he was a settler, and therefore it was for his own personal benefit. These transactions were recorded at cost price, which was less than the market value at the time of the transfer. So when he took it out for accounting purposes, he said, I have spent 50 rupees on these silver bars. When I take out, I'm just going to say that 50 rupees has been taken out. These transactions were recorded at cost price, which was less than the market value at the time of transfer. The income tax authorities sought to tax him on the market value of the silver and shares at the time of withdrawal, treating it as a taxable income. And so the income tax authorities are saying that when you take out the silver bars, it is as if you're sold the silver bars to somebody else in the market. And the issue was whether the transfer of silver bars and shares from the business stock to the personal account of the business owner constituted a sale or a taxable event. And the Indian Supreme Court here, unlike Sharkey versus Werner, unlike the English cases, said that no profit arises from a transfer of stock to oneself. No, and here, of course, it is stock. You can say transfer property to oneself. There cannot be any taxable income when a business owner withdraws stock for personal use because no actual profit, and when they say no actual profit, they mean no actual profit for tax purposes or gain was realized. Income tax is levied on real profits, not notional or unrealized gains. Right? So you can see straight away that there is a difference in treatment between the way um, the English cases treated this and the way the Indian cases treated it, right? And they said that income tax has to be realized, and there's no realization event happening here at the time. You can't trade with yourself when you're transferring that, right? So I wanted to bring this out to you because it's important that we understand that but within the definition of income, or within the idea of income in the Income Tax Act, this idea of realization of income is important. It could be that there's been some notional, it could be that there's some economic benefit of the sort we were discussing earlier when you withdraw something from your own stock, and but all economic benefits per se, for that very reason alone, should not be taxed for income tax reasons. You should be able to prove that there's been a realization event for tax purposes. Now, this case was then followed by another case called, another very interesting case called CIT versus Shirin Bai Kuka, which initially was in the Bombay High Court, and what I'm discussing here is Bombay High Court decision, but it was then confirmed by the Supreme Court as well. In this case, Shirin Bai Kuka was a share dealer who initially held shares as an investment. Later on, she decided to convert her shares from investment to stock in trade. So remember that you can hold property in various ways. So, for example, if I own land or I own a house, I can own that house or land as an investment, as my capital asset, as something that I have, and I may sell it in the future, I may not sell it. Or I can hold it like how I hold fruits and vegetables in my shop, which is I'm holding something in order to make profit out of it by selling it and selling it regularly, right? So that's the difference between investment and what we call a stock in trade, right? Um, and Shirin Bai Kuka was a share dealer who held some shares as an investment, not as a stock in trade, not as fruits and vegetables, but as an investment. And later on, she decided to convert her shares from investment to stock in trade. And then after that, at some point of time, she subsequently sold the shares at a profit. And the issue here was, what is the proper method of calculation of the profits from the sale of shares, from the subsequent sale of shares later on, right? After she had decided to convert her shares from investment to stock in trade, what is the proper method of calculation of the profits from the sale of shares, which has been converted from investment to stock in trade? Should the cost of the shares be their original cost or the value at the time when the shares were converted from investment to stock in trade? Now, the Supreme Court clarified that when the shares were converted from investment into stock in trade and later sold, the cost of the shares in our hands will be the value of the shares at the time when the shares were converted from investment to stock in trade, not when these shares were initially bought by her. Friends, this is what I want you people to do. I want you to take a look at this case. I've just given you the facts. The facts are before you. I'm going to make sure that that all of you are reading these facts, and I want you to tell me whether this decision follows through from the previous decision in Kikabai Premchand or not. Right. So listen carefully to what I'm asking you to think about. Whether this decision that's in front of you follows through is a consequence of the decision in the previous Supreme Court case that we just discussed of Kikabai versus Premchand. This is a slightly complicated matter, so I'm going to give you 10 minutes to think about it. Don't worry about Googling this and all that. Just think about this. How are you going to approach this question, this issue? Do you agree with the Supreme Court? Right? And I want you to take a shot at it first, slightly complicated. I want you to take a shot at it first. After 10 minutes, I'm going to come back and ask you, and then let me give you my answer. Yeah, so just take a look at it. I'm going to leave you here for 10 minutes. Take a look at it, and then tell me what you think. I'll leave it with you. Don't worry. Sorry. Can you hear me now? I think you should be able to hear me now, right? Okay, so Indulekha has written that in the first instance, shares getting converted to stock in trade, there is no realization and no profit has arisen and no tax will be levied. While in the second step, when the shares are sold, there is realization of income, hence tax should be calculated based on difference between the first acquisition cost of shares and the current selling price. Great. Yeah, I think I understand that analysis, Indulekha, and what you're saying is that um, what's really important for tax purposes is the current transaction, and the current transaction, there's a difference between the price in the market that it has achieved minus the cost of the shares. And what's important is how do we understand what the cost of the shares are, and according to you, the cost of the shares refers to the cost at the time the shares were initially purchased by the taxpayer. Does anyone have a difference of opinion? I don't see anything in the chat box, but yes, Siddharth. Yes, please. Go ahead.
So, as far as I understand,
Hmm.
that assuming that the shares were purchased at rupees 10 as an
Hmm.
investment,
Hmm.
when those shares were converted to stock in trade,
Mm-hmm.
assuming the price of the share was 12 rupees.
Yes.
So that means the person is earning a 2 rupees profit on that investment.
Uh, I mean, it was converted, so that's right. So there's a at the time of conversion, the shares were worth 12 rupees in the market. Go on.
Right. But that is also an investment. So he's earning something on that investment, which is an income.
Well, at the time they were converted into stock in trade, it was 12 rupees. And you're saying the difference between 12 and 10 is 2 rupees. And so therefore there's a 2 rupees profit. That's what you're saying?
Right. Right. On an
Oh,
investment. Thereafter,
okay. But
when
hold
this
on, hold on one second,
right.
one second, one second. Now, this point that you're making, isn't that going against the Kikabai Premchand ratio, which says that if somebody takes something out from one part of their life to another part, they are only just trading with themselves. There's no profit or income realization for tax purposes.
Not really, sir, because the heads are different. As far as as far as I understand, that one is an investment. In that Kika Bhai case, that was that was for self-use.
Yes,
So this is
but
not for self-use. This is an investment.
um, well, I mean, whether it is for investment or self-use, um, isn't it true that you're only trading with yourself? You're only working with yourself. It's the same person.
It's not working per se.
Sorry,
If I purchase something,
you're just engaging with yourself. That's what I meant here.
right, that can be the
Surely,
case.
yeah, surely that. I thought one reading of the Kikabai Premchand case is that it's not about whether somebody is transferring it from one profitable activity to another, which is what you're trying to say, right, Siddharth? That is, unlike the Shaki case, or the Kikabai Premchand case, it's not going from taxable to non-taxable. It's going from taxable to taxable. Um,
Right.
in Shirin by Kuka, but I thought while that is quite true, the underlying reason for rejection of any profit for income tax purposes is not so much whether it's going from one profitable source to another, but that it is going from the one person to that very person, which really is nothing for income tax purposes. Yeah. So let's think about it more. Yeah. Somebody else had raised their hand, right? Is it?
Yes, sir.
Yes. Tell me. Yes. Yeah.
So I think the
Who's
details
this?
of the
Rohil. Yes. Yes. Rohil. Yeah.
so when it comes to the details of the first case of the silver bars, and when we compare it to the second one, I feel there is limited information in the silver bars. For example, when the person withdraws the money, withdraws the silver bars from the business, there's a transfer of stock, and that is where the case ends. Whereas in the second case, the person is converting it. The person is first selling those shares and then he's converting it to another source. So in this case, we don't have enough information in the first case whether he's selling. So if he was selling those bars, if the person was withdrawing and selling those bars, then he would have to pay that profit on realization. But in this case, there is more information to this. Hence, we can say that there's a computation of tax and there is tax levied in the following case.
Yeah, but even if I gave you that further information, I don't know whether it'll change your mind. Suppose I say that he had withdrawn the silver bars and then later on sold it. Our problem is not so much at the time of sale, which is the case in Shirin Bhai Kuka. In Kika Bhai Premchand, the question is at the time of withdrawal of the silver bars, is there an income tax for tax purposes? If the answer is no, which is what the Supreme Court said, then we need to ask ourselves what are the knock-on consequences. For example, in Shirin Bhai Kuka, in this case, what we're considering right now here, where this lady held it as investment, and I'm going to use the same numbers that Siddharth was using. He at the time she held it as investments, it was when she bought it as an investment, it was 10 rupees, and then she converted that into a stock in trade. At the time of conversion, it was worth 12 rupees. She made, I mean, in some ways, you could say a 2 rupees profit. But Kikabai Premchand comes in and says, at that point of time, you are not allowed to say that there's any profit there because of the Kikabai, because of the Supreme Court decision, right? Because she's just dealing with herself, right? It's just going from one pocket to another, right?
Right.
And then later on, she sells it after it's been converted. She sells it for 15 rupees. And at this point of time, there's a separate legal question. The question there is when you sell property, when you're in business and when you sell property, the profit you make is the difference between the selling price and the cost. Selling price is
Right.
15. The problem is what is the cost? Is the cost 12 or is the cost 10? Now, remember that she was not taxed when it was at 12 because of
Correct.
Kikabai Premchand. So
Correct.
logically speaking,
Hmm.
you would say that the difference when she eventually sells it at 15 should be
Hmm.
15 minus 10 and not
Correct.
15 minus 12, right?
Correct.
However, in this case, it was the Supreme Court said the profit should be 15 minus 12, not 15 minus 10.
So, but that makes a huge loophole in the entire system, right?
Yeah, but
Because
let's come to that part. But my question is, is a Supreme Court decision in Kikabai, in Shirin Bai Kuka, the second case, is the Supreme Court decision logically defensible, right? Considering that there is no tax at the point of conversion, but when you finally tax it, the cost you're taking is the cost at the time of conversion, not at the time of initially buying it, which is, and remember the way Indulekha analyzed it, she's analyzed it as 15 minus 10, right? And the way Supreme Court analyzed it, it's been analyzed as 15 minus 12. I have Royal, hold on. I have an unknown user, so I don't know who this person is, and let me just read out what this person is saying, and let's see if we can make sense of it. In Kikabai, there was no actual monetary or physical monetary realization, but in Shirinbai, these are financial instruments, so there is actual realization of income when the shares were sold. So there would be a tax levied, and it also falls in both heads: income from sale of securities, and also from when it was converted from investment to stock in trade. And the problem is that yes, there is an actual sale. The question we're asking is not whether there's a tax at that actual sale. We know there will be a tax. The question is what will be the cost price for purposes of the actual sale. And if you're telling me that the cost price is going to be 12 instead of 10, just to use Siddharth's numbers, then we have a problem on our hands because at the time of conversion, there was no tax because of the Supreme Court decision. And at the time of sale, we are taking, there's a bump up in the cost We are not taking the cost as 12, but as 10. Other than Rohil, is there anybody else who had raised their hands and who I didn't call on? I'm going to say a few more things about this, but before that, I just want to gather some thoughts from the audience. Is there anybody else here who had raised their hands or want to talk, but not Rohil? Not Rohil for the time being. Anybody else? All right. So here's my question to the class. We have done three cases. We have done we have done Shaki versus Werner, we have done Kika by Premchand, and we have done Shirin by Kuka. Um, those facts and the case reasoning and all that is there in the course materials. You can take a look at it. The reasoning is there um, from page from note um, um, from note 3 onwards, page 21. We discuss a Sharkey versus Werner case. In all these common law cases, there's always a majority opinion and a minority opinion. So there are differences of opinion even within the case. But the majority opinion is opinion that carries the day. And so there is some majority opinion given to you here. And then there is a minority opinion given here. This is note 3. And then on note on page 30, we discuss the Kika by Premchand case. Again, there's a majority opinion and there's a minority opinion that's given here. Note 4 on page 34 talks about Shirin by Kuka case, and it talks about the dissenting opinion in the Shirin by Kuka case, followed by note 5, which is a CIT versus Shirin by Kuka, which is the case, the majority opinion that's there. Now, I want all of you to go to note 6, which is on page 42. And I've summarized the case law on the Sharkey type cases. And I'm going to read it out for you. And then we'll see where we are. Right. So note 6, page 42 of the course materials. Note on Indian case law on Sharkey type cases. Now, the Supreme Court in Kika by Premchand stated that, sorry, just give me 1 second. I noticed that Tanmay's hands are raised. Tanmay, did you have a question or a comment?
Sir, there is a glitch in the app, so I cannot able to unraise
Okay.
this hand.
All right, no worries, no worries, no worries. Okay. So note on Indian case law on Sharkey type cases. The Supreme Court in Kika by Premchand stated that when a person transfers an asset out of his business, he would not be subject to taxation because no one can trade with himself, and that the income tax legislation can tax only real gains and not fictional gains. The Supreme Court's decision was exactly the opposite of that in Sharkey, which is a House of Lords decision in England. The impact of the Kika by Premchand decision was tested in the Bombay High Court decision in Shirin by Kuka. In Shirin by Kuka, the taxpayer transferred shares from her investment account, shares she held as a long-term investment, to her trading account, shares she held for making profits in the short term by buying and selling, and then sold the shares subsequently. The issue was whether the cost of the asset in the hands of the taxpayer would be the price at which she bought the asset initially, or the price of the asset in the market on the date when the asset was transferred to the trading account of the taxpayer. The Bombay High Court held, and it was endorsed by the Supreme Court in appeal, that the cost would be the price at which the asset entering the trading account of the taxpayer, that is the fair market value of the shares at the time of the conversion of the shares from an investment asset held with the purpose of holding on to the asset for the long term into a trading asset held with the purpose of making a profit by selling the shares in the short term. The Bombay High Court was the opinion that in determining the real profits of a business, the price at which the asset comes into the business has to be taken into account as the cost of the asset to the business. Right? The Bombay High Court stated that it was concerned with real profits, not ordinary profits, whereas the Supreme Court in the Kikabai Premchand was concerned with issues of an imaginary profit. Now, in my opinion, this decision, at least on the face of it, unless we examine it further, at least on the face of it, this decision is difficult to reconcile with the Supreme Court issue. Right? The Supreme Court wanted to ignore, for tax purposes, any transaction that takes place between the same person. Now, if this approach is followed consistently, then the conversion of a capital asset into a trading stock has to be ignored because it did not leave the taxpayer's control and possession, and therefore the only relevant event for tax purposes in the Shirinbai Kuka case is the cost for which the taxpayer bought the asset originally. Yeah, so that's where we are now. My points 10 and 11, please, I'm going to read it out, but don't worry about it too much. We'll return to this later. These are issues of statute. Both the Kikabai Premchand case and the Shirinbai case have been overruled by statute. Kikabai Premchand is addressed by amending the charging section for business income, which is section 28, and which we'll come to later on in the course, by the introduction of 28 clause 6 clause A. These section numbers are the 1961 Act section numbers. When we come to section 28 later on in the course, I'll tell you the new Act numbers. The new Act, as I said, is now applicable from next year in April. Section 28, by the introduction of section 28 clause 6 clause A, which states that a conversion of a trading asset into a capital asset would be considered as trading income to the extent of the difference between the fair market value of the trading asset at the time of the conversion and its cost to the taxpayer. There is a corresponding amendment to the definition of income, introducing section 2 clause 12 clause A that includes the event of a conversion of a trading asset in the definition of income. And similarly, Shirinbai Kuka is addressed by amending the capital gains charging provision, section 45, again section 45 of the 1961 Act, by the introduction of section 45 clause 2, which states that the conversion of a capital asset into a trading asset would result in a capital gain in the year in which the asset is transferred to the extent of the differences between the fair market value of the capital asset at the time of the conversion and its cost to the taxpayer. There is a corresponding amendment introducing section 2 clause 47(4) that defines a transfer as including a situation in which a person treats an asset as a stock in trade. But of course, there's no corresponding amendment to the definition of income in section 2 because section 2 clause 6 already deems capital gains to be income. Friends, don't worry about points 10 and 11. Those are statutory matters we'll come to when we go to the respective heads of income, business income, and capital gains. I wanted to put it in here to alert you to the fact that the Shirinbai Kuka case and the Kikabai Premchand case have been overruled to a certain extent, to a limited extent, and as you can see here. But don't worry about that. Let's just come back to the fundamental principles that we've been talking about. Let me ask, and let me ask the class. As I said, you must, after this class is over, go over the decisions, the excerpts that I've given in my course materials, both for Kikabai Premchand and for Shirinbai Kuka. But let me ask the class this question, though, which is important, which is, in your opinion, if you were asked to explain the rationale, reason for the decision in Kikabai Premchand, how would you rationalize it? Let's start with that. If you were asked to rationalize the decision, tell me in your own words the reason. Don't worry if you're getting it wrong. This is a pedagogical exercise. We're teaching and learning here. If you were asked to explain the reasons or in your own words, for why the court decided the way it did in Kikabai Premchand, how would you go about it? What would you say would be the reason? Yeah, anyone? Raise your hands, please, or chat box. Both are possible ways of doing it. Um, please think about it and tell me. I need to hear from you. Yeah. And I'm going to wait to hear from you. Anyone. And preferably somebody who's not spoken before. I see there are lots of people here. I see there are 40 people in the audience. Don't worry about getting it wrong. It's not, nobody's judging you here. I'm not certainly not going to judge you at all. This is a way of participating in the class and less tedious, more interesting. So anyone wants to say anything? The question I'm asking is very simple. If I were to tell you, Kikabai Premchand said there's no tax when somebody withdraws stock from their own business, um, and um, and they use it for their own use. What, according to you, is the rational reason for this? Right now, Rohil has raised his hand, but Rohil has been talking in the past as well. Is there anybody other than Rohil who would like to talk? But Rohil, you can start. But I also want to encourage other people to talk as well. Yes, Rohil, go ahead.
So I'm not sure about this, but I'm guessing that because it was a sole proprietorship, the liability
See,
and the business and the person.
sorry. For the rest of the class, a sole proprietorship is a person who's an individual. He's not incorporated his business. Yeah, go on, Rohit.
So I'm guessing that the business and the person is considered as the same entity and there's no separate legal entity. Because of this, the tax liability is calculated that way.
Yeah, so that's right, Rohit. The idea is that no one, even if somebody, as I said before, perhaps he was benefiting from this, right? But even if you're benefiting, for purposes of income tax, there is no income. And what I want you to tell me, Rohil, and this is important not just for this question, but for many other questions in tax law. What might be the principle on the basis which there is? See, suppose that a court tells you the principle here is no one can make, even if they benefit, no one can make a profit out of their own dealings. Where are they getting that from? Where is that principle coming from? We must always, as students of tax law, ask that question, that follow-up question. Where are they getting it from? Any thoughts, Rohit?
So I think the answer comes to the fact that there's no rational way of telling or deciding what the selling price of something should be. It is a very subjective matter. In the case of silver, yes, that might be the market value, but in all other instances, such as the furniture, it totally depends on the person who's deciding to sell it. But yes,
So
I'm a little confused in this as well.
that's a very good point. So I want the class to appreciate what Rohil is saying, right? So, Rohil, I'm going to finesse your argument a little bit and tell me whether you disagree with me or not. Here's the way Rohil is making an argument, right? Um, income tax is imposed not in the abstract, but in terms of the various schedules or heads of income to which it can be imposed. The closest head of income here is business income. Business income is of a nature where we must be clear about the values and profits being realized in business. We can't we can't impose a tax under the head business income on speculative reasons. In this case, it looks to us that we can never really be sure what profits a person makes when a person deals with himself, withdraws the goods for his own purposes. And therefore, it is in the because of the nature of the business income schedule or the profit schedule, that we are able to say that in these kind of situations where a person is just acting with himself, engaging with himself, that there should be no income for income tax purposes. This is a question of whether income is realized, but that question of whether income is realized is a scheduler question. It is intimately connected with how we imagine what the nature of business income is under the business income schedule. Rohil, is that a good way of putting it?
Yes, sir.
Yeah. Is there anybody else who wanted to jump in? Let me see. Indulekha has said that in Ikabai the tax would be higher because of the time value of money of the underlying asset hence good for the government. Yes, that's right. I think it will be good for the government if they're able to say that the cost would be oh, sorry, I'm talking about Kika by, not Shirin by Kika. Kika by Premchand. The tax would be higher because of the time value of the money of the underlying asset. I'm not able to understand that point, Ikulekha. I can understand your point if you're making this point regarding the second case, the Kika by the Shirin by Kuka case, where the government would benefit if it took the cost of the asset as the cost that was there at the time they initially bought the property. Now, Dutt Kunduri is saying that perhaps we can explain the discrepancy because the assets in Kikabai were far less liquid and hence far less realizable for income tax purposes than the asset in Shirin by Kuka. And might well be true that the assets were far less liquid. But and actually, that brings me to the second question. So we have understood what the. I'll come back to this liquidity idea that you said that in a second. But we have understood perhaps a rationale for the Kika by Premchand case, which is that we look into the business schedule, and the business schedule does not capture the kind of income or gain that the taxpayer is benefiting from. But then, how do you then, as a follow-up act, how do you then rationalize what might be? How would you, in a matter of a few sentences, much like what Rohil did for Kikabai Premchand, how would you, in like a matter of a few sentences, uh, rationalize, justify the following decision in Kuka, in Shirin by Kuka? Can somebody tell me, please? Let's see. I don't see any hands raised. I'm going to assume that Tanmai's hand is not raised. So I don't see any other hand raised. I don't see anything in the in the chat box either. Yes, Henry. Yes. Yes, Henry. Go ahead.
Yeah.
I can't.
So
I can't hear you.
In Shiranbai, the main intention was to make profits out of the shares to converted it to from investment to stock in trade. That's why they've calculated that as the income. So in the earlier case, there was just a transfer of the silver bars and shares from his business to himself, personal account.
So what you're telling me, no, but you're not giving me. You give me some kind of a justification in words. So if I were to ask you, let me ask you a separate question.
Yes, sir.
If I were to tell you that, okay, does it in Shirin by Kuka, how is it that the person doesn't make any profits at the time of conversion, but at the time of the eventual sale is able to take advantage of the cost price at the time of conversion?
So until it was converted, the main intention was to keep it for long-term investment, as such, sir, in
Okay,
Shiranbai.
carry on. Yes,
Then,
so carry on.
so that's when the taxable event arises.
Yeah, no, I understand. There's a taxable event at the time of sale, eventual sale.
Yes,
How
sir.
is it that she's able to, the taxpayer is able to escape tax at the first stage and yet take advantage of the bump up in cost at the second stage?
So I'm not really able to put it in words, sir, but
This is a very interesting question, right? And we will, when we come back next
yes,
class,
sir.
we will try to put this in words and see how and see what we can gain from it. But one more thing, I'll leave you. I'll leave the class with one more thought. First, we have to figure out how to justify the second case. Second, we have to understand why is this important for us. Why are some exotic things about self-dealing and Shirin Bai Kuka and Kakiaba Penju? Why is it important for us as students of tax law? That's the second thing that I wanted people to think about. Okay, have a nice weekend, all of you, and we will reconvene. in a couple of weeks' time. See you. Bye.
Thank you, sir.